Charm and Vana and Vega. We're continuing from last week with the Traders Workshop and the lads. They're coming on. We're going to finish this baby up today. Among other things, I've got a 0 DTE question for the guys. So anyway, let's get started with the opening. Bill. Well, Happy New Year, gents. What the heck?
Happy New Year. I hope you took profits.
Yeah, right. So not too unusual of a scenario, right, Mark? I mean, especially, I can't tell you how many times at the end of a new year back in the trading days. What happened to Jason? He disappeared.
I'm sorry.
Yeah, no worries. You're just blurring out. That we had the big run up, the Santa Claus rally, only to find the first few days of the new year where we start getting back to reality a little bit, and a little bit of, I don't know, is it profit taking, rolling taxes into the next year? Who knows?
Yeah, I mean, at the end of the day, like, more sellers than buyers, but I think a lot of that is driven by, like you said, profit taking, repositioning, rebalancing. Like, definitely makes sense. I don't know that this is necessarily indicative of anything like majorly structural yet, but it's a rude awakening after champagne headache.
Yeah, no, I agree. It's, it's not horrible either yet. I mean, as you said, Jason, question to you. So you had a time frame toward the end of January for some sort of a pullback from memory. And I mentioned that I had a position on in the QQQs, a short delta position to sort of take advantage of what I thought was going to be the same thing. And you might have mentioned to me that maybe January was too aggressive of a time horizon. It might be better to push it off into February. You still feel that way?
Yeah, I mean, the January option expiration has a lot of like kind of dealer Vega, like it's got a lot of positions that are going to be rolling off. And even still now, dealers are going to have to sell deltas when they roll off. So I think that overall, I think what I would do is I would probably push it out to like February. I mean, collect your little bit of profits now. I do think that, I mean, this little drop and end of year rehedging since the last time we spoke has kind of normalized dealer Vega a little bit. So Vana is still very high. So, I mean, we can fade back up now into January OPEX. And then we'll see what happens when all those deltas come down. I think that a lot of the rehedging that is in January is in next January already. So.
Okay. Yeah. Wow. So
why do dealers have deltas to sell come the roll off?
I'm sorry.
Like, why do dealers have deltas to sell?
There's a lot of in the money calls that the dealers are holding. And so they're they have a lot of short there, but then they also have a lot of puts as well. So, I mean, instead of those in the money calls expiring at Delta 0, they're going to be going up into
Delta 100. Yeah.
So, I mean, they're going to be selling into it. And I think that might have been a part of what we've just seen here today. So,
so real quickly, maybe, Jason, probably for you, but Mark, feel free to chime in. As a review from last week, your thesis is that Vega has a more profound effect on market movement, dealer market movement, I should say, than maybe the other two Greek sub-Greeks we talk about a lot, Vana and Charm. Charm may be more in the 0 DTE world, but in general, Vega might have a more profound effect. Is that accurate? Just refresh our memories.
So, yeah, to answer so we were talking last week about the white paper that we published and how Vega, implied Vega is calculated with the change in VIX. The Vega hedging that is implied by dealer positioning is much more correlated to the market than gamma. And so that's kind of, it's really the Vega positioning. Vega drops off considerably after January OPEX, which, I was going to finish the answer there. Okay. But so basically what we were kind of seeing is that was a strong correlation. And last week we were talking about, well, how do dealers actually manage their Vega? Because they don't buy a lot of VIX products. They don't, there's a little bit of dispersion across other stocks, but if they are in the sold call area of, if they're in the sold call area of their positioning, so I guess they're long calls, then, how do they manage that when they're in positive Vega? What do they do? And how does that affect the market?
Yeah. So Mark, I'll let you kind of give the rehash of the answer. You had a good answer to the urgency in the dealer community of hedging Vega, which, I think you and I agree on it, isn't as immediate as, let's say, hedging Delta, right? So can you give us a little rundown of your thoughts there again on Vega management among dealers?
Yeah, I think sort of what we were saying last week, right, is that Vega is the one Greek or the main Greek, I should say, that dealers tend to warehouse. Like you say, directional risks like deltas, those are either hedged at the time of trade. Like if you have a hard delta from a trade, you buy 70 delta calls, you sell 70 deltas of futures against that. But like then there's the gamma, which we broadly call, I realize it's not all gamma hedging, it's a lot of Greek hedging, but like gamma hedging or soft deltas is all of the other position movements that happen from implied vol or whatnot. But delta, you want flat, right? No matter where it comes from, trade, position, whatnot. Vega, like there isn't an easy off lay, right? Like that's definitely what you're wearing day over day, over the course of the week, over the course of years, if you're long or short leaps. And so I'd say that like the urgency to manage that is significantly less. And really you manage that by adjusting your markets. If you're long Vega and there are lots of sellers of Vega and you keep buying it, well, you keep lowering the price until you find someone that's willing to buy it from you, and vice versa on the upside, right? So I don't think upside or downside, long or short. I think it's all the same game of just adjusting your curves to find that, two-sided flow.
Yeah, and those are good points. And then, quite honestly, for your purposes, Jason, what Mark just said. So think about it. If dealers are continually buying, we'll just use the buying side. If they're continually buying Vega and they're lowering prices, and then all of a sudden they find a buyer and they can sell, technically their first entry point of a buy of Vega is going to be a loss on that sale, right? I mean, assuming they've lowered it enough. So they're going to absolutely take a Vega loss by selling that first option after they've lowered it pretty far. But I would say that the way the model works for them is that there's so much bid-ask trading along the way that they've increased their net licks and their value that, instead of taking a big Vega risk, they're going to take that first loss in the hopes that, we snap back. We're never catching the falling knife. I can't remember a time when I bought vol as a firm and said, oh my God, I caught the bottom and the next tick was up, right? It's warehousing, like Mark said. So, we play this little dance in the pro world that, hey, we're not going to get saddled with anything we don't want to have. I can tell you that for the most part, right? We're going to move markets aggressively as needed. Right, Mark?
You never want to be in the position of defending a position, right?
That's
you
right.
never want to be like, I own this vol because it's cheap. Like that's the quickest way to find the door.
Yeah. Let's go ahead, Mark. Jason, sorry.
I'm sorry. Yeah, I didn't mean to interrupt. So I guess the last couple of weeks of December, we started seeing strong, like positive Vega, like aggregate positioning. And when you checked in Volin, you saw that we were in the money on like 4,600, 4,700 sold calls because we rose so fast from the October lows into December. So they're positive Vega. They keep lowering and lowering those call prices, and we noticed that it was very, very low IV compared to RV, compared to like our the Vena positioning. I mean, compared to everything, those prices were very low, and those were calls. So I guess they're just trying to entice somebody to buy those calls, but what if they never find somebody to buy those calls?
Mark, you want to take a shot at that? I know what I'm going to say, but go ahead.
Then it means you haven't lowered it enough, right? Like, I think it's like as simple and as complicated as that, right? Like we're making a very complicated and delicate dance sound very simple. And I think that's where the skill of like people who are truly great traders like can navigate much better. And like that's an innate and learned, quality. But like that, if you're long and you're not selling, that means your price is too high, right?
Yeah.
Like, so I think it's just means if no one's buying from you, that means you got to lower the price.
Yeah. Until you find equilibrium, right? And don't get us wrong about that. When you lower that price and you're still not finding someone, there's going to come a point when you've taken a pretty major loss along the way. Right. It's going to be it's going to hurt. And I can tell you from experience that has happened to us in the past. Our initial price was too high. And then the next one was still too high, and so on and so forth. Well, we've lost along the way. And we had, I like I told you before 9/11, which is a long time ago, 2001, leading up into that, we were chewing on vol. It was just jammed down our throats, and we were sucking on it, and it was not good. Right. Well, we know what happened. And that was fortuitous for the position, horrible for the country, but fortuitous for the position. But you know what? I'm not saying we dodge out of every bullet. We don't. There are losses.
Liquidity can be deceptive, right? Like you might be lowering it and seeing your Theo at the bid, or you might even be seeing your ask at the bid. And market makers tend to be very hesitant to like cross the spread, although some of the best ones are good at doing it when it needs to be. Yep. But like if there's a deceptive bid out there that actually isn't buying, you need to know that there's sort of like fake liquidity out there. Maybe it's another slow market maker that hasn't lowered theirs enough. They're certainly not going to be buying from you. So being able to like read between the lines of what true liquidity is, where true like customer or natural order flow is, it's finding that equilibrium in order flow, not just like on the screens.
Yeah. And the other thing too, for your purposes, Jason, just as a point is in a perfect world for a market maker or a dealer, pricing is perfect, meaning people are buying and selling consecutively, right? So we don't really warehouse Vega at all. Our vol is 0 because I'm buying my bid, selling my offer all the time. Now, clearly that doesn't happen, but that's perfect for someone that we find that equilibrium, because where our edge lies is in that bid ask, mainly because we can hedge delta easily. That's super easy. Right. So if we're getting two-sided paper, I never have a position technically, right? I'm getting out of it all the time. It might not look like it on my sheets, but it's all converted and reversaled off and boxed off. And, I'm just moving things around and just running to the bank every day. Now, as I said, that doesn't typically happen. That's a dream for a trader. But I would say it happens, but not very often, I should say.
I see. So when a market maker is losing money, like let's say, again, like October to December, it was just this one-way market going straight up.
Yep.
It went into, sold calls that are ready for January 19th. Mm-hmm. The dealers are now positive Vega, even though now, not currently, but back then they were. And you said they're chewing on the loss because they can't find that buyer. I mean, vol dropped off a planet in late October into early November, kind of foreseeing how far this can go up. But what do you do? I mean, you don't just like say I lost money and then walk away, right? Like how do you handle a loss or a prospective loss?
Mm-hmm.
Mark, for the most part, like we thought about our P&L much more on like a day-to-day basis, and you hope the position was flat at the end of the day. And if your position was determining your P&L rather than your edge collection, that means you had too big of positions and something was broken in your process about how you were accepting and pricing trades. And so like your position should just be noise and variance. Like that should just be, the variance, like I said, around estimated fair value, and everything you do should be, all of your profits and your revenue is driven by your daily edge collection, using that day trading to keep a flat position that isn't going to cost you money.
Right. That's the ideal scenario for a market maker, right? Mm-hmm. And that edge collection is a good term. I like that. I'm going to coin that and give you full credit. Edge collection. because I speak about edge a lot, and in my struggle with retail trading, okay, is where does the edge lie for a retail person? Mark and I know exactly where it lies for a professional, right? A market maker. Their edge to enter a trade is generally negative, almost always negative, because they have to pay something beyond midpoint or sell something under midpoint to get into the trade. Already you're in a negative edge situation, right? Market makers have already collected that edge. And don't forget, they're doing that all day long across hundreds and hundreds of positions. So that number adds up, right? That edge collection. So naturally, having said that, as long as there's activity, a market making firm truly doesn't need to have a position, right? I mean, that's ideal. They really don't need to have it because they have such an advantage in collecting that edge daily, right? As long as there's trading activity, they can do that, right? And one of the things, the other thing too is, one of the reasons some market making firms, and Mark, yours was probably like this, that could take on positive gamma, positive Vega, paying theta is because of that edge collection. They could offset those weights in an options portfolio by the edge collection. And at worst case, try to remain neutral on a day, hoping for that vol expansion or that big move because they have the gamma and the vol, right? You can't do that as a retail person. I'm sorry, you just can't. You don't have the ability to keep, generating that edge model. Does that make sense, Mark? Add something to that if you feel you need to.
No, I totally agree. I mean, like, you're charging the premium over the market fair value because you are holding that contract for some indeterminate period of time. The longer that time might be, whether it's liquidity based in a low tier issue or duration based in like a leap or whatnot, you're going to charge more for that. If you think your ability to get out of that is very quick, you can charge very little because your warehousing is low. Warehousing in terms of cost of carry, in terms of paying the people that sit at computers to manage that, in terms of hedging that over time, right? Like all those little costs eat into the gross revenue in terms of sale price versus, fair value. And you need to adjust your margins to account for all of those pricing things. Or like, I shouldn't say pricing things. You need to adjust your pricing to account for all of those transactions, warehousing, maintenance costs.
Right. So, and here's another part of the equation too. Now think about this. So naturally, if what we say is true about market making community, dealer community, right? What happens when they are tasked with having to make markets in illiquid underlines, stocks that don't trade a lot of options? What do you notice? Markets are wider. Why are they wider? Because the market maker now doesn't have the ability. That market maker is going to have inventory naturally because of lack of liquidity, right? There's no ability or very little ability to get in and out of that. So what happens? The markets widen as a result because market makers need more edge to take that inventory because they know they can't get out of it. So that's what you see in those kind of stocks. And I think, Mark, your firm loved to trade, not the really D class, maybe super illiquid ones, but things where you had to have a position on, but you're gonna have a lot of edge to have it. Is that
oh no,
fair?
we used to, I mean, we were in like the tiers E's and F's, like I think tier F is actually technically, if you go by the SIBO's term, it's like the bottom half of issues, like names that trade less than 500 contracts a day or 1,000 contracts a day. But like you say, like we used to warehouse a lot of risk very expensively there. And like, those are the kinds of issues where you have to move your pricing manually. You have to use like a Sabre-like curve to adjust your model. You can't just say fit to the market and I'm going to ride the bid ask in, Apple or Microsoft or something. And like you say, you warehouse big risk and, your variance in P&L was much bigger there. But generally, if you charge the right price, it could work out as well or better as the liquid issues.
Yeah. So, you're good, Jason. Sorry.
I'm sorry. I feel like I keep interrupting you, Lex.
No. I didn't know if you wanted to say something, but
no. So
your take.
All right. So then, from a data standpoint, when we step back, the observation that is popular, which is the spot vol correlation, the implied volatility and SPX changing in tandem, and the vol and Vega aggregate Vega hedging compared to SPX change, what would cause that then, do you think? Since implied volatility is the pricing of what market makers are doing, and if implied volatility is going up or down, is that because of the soft deltas that move the market? Is it the market moving the soft deltas of the market maker, so then they have to change their pricing?
Yep.
Or what do you think it is?
So I think it's probably a little combo of both potentially. So if let's say the market maker's short gamma and the market's moving up, so spots moving up. So what's their exposure? Well, all of a sudden their exposure becomes delta, right? Which they can hedge fairly easily, as we've talked about on the show a lot. Relative to gamma clusters, Vana, Charm, we know what happens and we know what the dealers are doing there. So I don't need an option to trade to hedge that part of the curve. So is it spot moving where I change my prices? Not necessarily. Depends, I think. It depends on what new inventory I'm getting because of the spot moving. Am I getting more of the same, or am I getting out of what I already have? Right.
Okay.
So there's a big difference there. And I don't know. I don't have a straight rule of thumb there, because I don't know what the paper is going to do to me after that spot moves. Right. So in a good scenario, let's say I have a big down move and I'm long downside vol and I've got tons of gamma. You know what? I've made a decent amount of money on that move. I'm probably hedging deltas. If I can hedge deltas by selling something that's been elevated, I'm going to do that. Right. To some degree.
Mm-hmm. Well, another thing too is that most sophisticated market making shops are operating on, like, we called it sticky delta, but I'm sure there are a bunch of different terms for it. That if you have the skew curve, what that represents is the idea that if spot goes up to the 20 delta perspective, that fixed strike option that you are long, because you're not long delta options, you're long actual strikes and times, that vol is going to go down. So the delta of that's going to change. So your hedge today needs to be different, knowing that that's what your delta will be implied when the market moves to that different point, right? So already delta hedging is based on the implied deltas, the curves, movement points, not just where it is today.
Yeah, that's a good point, actually. And next time we should draw that out on the Remarkable, or Jason, you could maybe do it. Because the way we explain curves, I can't do my fingers, is that you have a baseline curve that could do this, right? A skew curve, but typically the movement of the underlying would ride along that curve. So if the 20 delta today became the 50 delta, that curve would move to that new volatility technically, unless something else happened. Yeah. And the curve would retain its shape generally, but the new volatility would be at the money at what was predicted from the previous 20 delta. I think that's what Mark was trying to say as well, right, Mark?
Exactly.
Yeah. So and don't. It's not a hard fast fact. There could be movement in the curve along the way, this way and that way, depending, right? And it depends on what paper's doing, what we have to respond to. So it's a great predictor, but not absolutely written in stone either.
Yeah. So what you're saying is that that
was a move. I did a move.
Oh,
that's a move.
I thought you were pointing.
No.
So what you're saying is sticky delta, then, just to clarify, is we see an implied skew in options. It typically goes up as the strikes decrease, and the market makers are pricing that skew based on what they think implied volatility will be if markets go down that far, right?
Yeah. And look at, over the years, we didn't have skew when I first started. Okay. It was more of a smile than a skew.
Options when you started.
That's true. That's a good point. But the curve was uniform, and it was probably skewed to the call side because the market only went up when I first started, right? Back in the late 80s. So the market was up all the time. So people bought calls. So market makers priced them, and the curve looked, instead of like this, it was elevated to the call side. Well, we needed a crash in 1987 to realize that prices go down a lot harder and more severe with velocity to the downside than they do to the upside. So all of a sudden the market making community said, wait a minute, this isn't a normal distribution of movement. It's going to be skewed, right? So we're going to price puts more dearly than we're going to price out of the money calls, right? Okay. Which was the right thing to do. And we've seen that in history, 2008, 1992, those kind of events to the downside can be teeth shattering, right? 2008 was very scary, but you got to get paid to sell puts. And they figure that out. And then they have, hold on, let me finish. Then they have the ability mathematically to figure out what a normal curve would look like. So where fair value for a curve was, and the steeper and flatter it would become could present an edge to a community, market making community, if they're managing that. Right? Mark, did you guys do that a little bit?
Yeah, definitely. And that's like a constantly evolving process, right? Like that's where there's a lot of like research and innovation about it. But
that's right.
At the end of the day, like no matter how good you are at pricing your hedge or your delta or what it's going to be at a given point or what the correlation is going to move the curve across different term structures or what, like at the end of the day, it's collecting edge and moving your curves fast enough.
Yep. Yeah, and we did it in human terms back when, again, when I first started, when people walked on all four limbs, that's when I started. We're like cavemen. But we did it manually back then. Think about how it's done today. Every little permutation in a market maker book, they can technically move electronically and systematically. And it's all interconnected now, from just mathematics and computer science. So these guys, you're not going to trick them with prices. You really aren't.
Yeah. But
that's a great thing. That's great. Like we don't want to be in a game of tricking market makers.
No.
Like,
right.
That's a fool's errand. Like the fact that markets are efficiently priced and people work so hard to do that, like is an amazing thing for the retail trader.
It is. I agree with that 100%.
So, all right. Okay, so now I have like a lot of questions now because of, but it sounds like, okay, if I'm to sum up then, spot vol correlation may happen because that is essentially the implied, I guess, the implied skew of the curve. So I can look at the current pricing of the curve and see what spot vol correlation should be.
Mm-hmm.
The reason why it exists is because it's more like the price moving the vol as opposed to the vol moving the price. I guess it seems, because if you're going up or down that curve, then they have like an implied pricing that is in existence based on wherever SPX is going. Delta independent because you're hedging that away. So when I see like a high Vanna, which Vanna is the slope of the Vega curve, of the implied Vega curve, what I should be seeing is, if Vanna is very high, then, and Vega is beginning to get lower, because if Vanna is high, that means you're on the maximized part of the implied Vega curve. Then I should be seeing a stronger skew than like a stronger movement in prices in like the skew curve, right? Like it should be steeper.
Mark, I'm going to bow to you on that. I don't think I understand the question.
Oh, sorry.
I don't know if I totally can wrap my head around it. I think
okay, sorry. I'm trying to wrap my head around it too. That's why I'm looking.
Maybe say it like this. I tried to say it like this. You try it like this.
Okay. I'm sorry, and I'm sure I'm looking at the ceiling because that's where all the answers are.
Me too.
So, all right, Vanna is the amount of Vega change that the dealers experience based on a movement in the underlying, right?
Okay.
Okay.
Yeah.
So what that means is that, like, when you plot a dealer Vega curve, like the implied Vega curve on the x-axis being the underlying, the y-axis being like the notional value, right?
Yep.
That Vanna, the more that Vanna is, the steeper the skew should be, because their Vega is going up and down and stronger, and that means your pricing has to go up and down stronger. Is that correct? Or is the Vanna going to change the skew of the curve a lot more?
So I would say that. So here's where I think this is going. Um, based on what dealers have positioned out of the money, okay,
Yeah.
Vana's going to define when implied volatility moves, how their delta moves.
Right.
Accurate? Okay.
Mhm.
What I would say is that it takes an underlying spot move to generally make that implied implied volatility to move significantly. That doesn't mean it can't move as time goes on, because if nothing's happening, implied volatility is going to come down, right? But the more profound effect, I think, is when we get a good spot move up or down, which will affect implied volatility more significantly, which will have a domino effect on because of Vana, right?
Right.
Now, if it goes from out of the money Vana to in the money Vana, that's all going to flip around again if the movement's so big. So yeah, I mean, big moves have a pretty big effect on the dealer book for sure, because of their Vana position and among others, I think. But typically just kind of washing around in the dirty bathwater, back and forth, nothing going on. It's decay and just boredom. That causes prices to move or implied volatility to come down because nothing's going on, especially if there's no trading. Even worse, right? Mark, add something if you want. Tell me about a good wine you had or something.
If I start talking about wine, I'm going to forget my point. But okay. I think maybe to get back to your question, Jason, instead of adjusting skew necessarily, I think it might mean that dealers shift the whole curve more or less. Like, I don't think that necessarily is going to tilt. Like, it might change the speed at which they're moving. Like, if they're accumulating Vega really quickly, like whether it's through spot movement or through sales, order flow, right? Like, and I think those are a little chicken and egg in some ways too. Like, that's going to maybe change the speed at which they adjust the curve. And it's hard to decipher whether a big move is a function of a changing volatility environment that moves the curve, that changes their Vega, or this like it's indecipherable whether like what causes the move or whether implied vol moves before or after, right? Like, normally if there's a big move, there's also a big change in expectations.
Yeah.
So that would change the speed of the curve movement also.
So the observation that we've made from October to December in particular, implied volatilities when the QRA came out, the Treasury thing, when that came out, implied vols tanked like really far below realized vols. Significantly, and it stayed that way through November, and then it turned out to manifest, which doesn't normally happen. Realized vol followed implied. What we've observed though is that the stronger, like the higher the dealer Vega number is, the less that spot vol correlation holds, or you start to see spot up vol up, something like that, and maintaining that whole time a very high Vana. So basically what I'm trying to figure out, I guess you could say, is how that relationship manifests, and then once I figure that out, then it can improve the trading using Volin data to say, okay, if Vega is very positive, and we're seeing a flattening of the curve, and we're seeing, because of the strong positive Vana, we're seeing like the 50 delta be percentage points, like 1% gain in SPX over the next 30 days. And so we're seeing the adjustment in the pricing based on the data that we're getting from Volin. And so it's like going in concert. I just wanted to figure out if those observations are correct or accurate, if they make sense to you. And if you're saying that they operate on sticky delta, I think they're trying to anticipate those moves based on our observation again. And if that anticipation, the difference in that anticipation is what causes market maker like hedging. Is that right? Like how far off their prediction is, their prediction being the current pricing, from what will actually happen.
Well, I'm thinking back to the spot vol correlation, and maybe independent of dealer positioning, I think I'd expect spot vol correlation to be less. I think I would expect spot and vol to be less correlated the lower vol is. And I would expect that to be higher the higher vol is.
That's a good point. I think that's right.
That's just kind of gut, but like, I think that tends to.
I mean, historically, it actually doesn't seem to matter, because when vol is low and it gets lower, price doesn't move that much, right? But when vol is high and it gets lower or higher, you know, price moves stronger in that, you know, it seems like the implied vol is, you know, whether it's foreshadowing SPX moves or you know, the other way is true, like you said, the chicken and the egg. But I think I think what I'm getting at is, and what I'm learning, and maybe I'll come back one day with another kind of study or something that shows the Voland implied Vanna and Vega curve, and you know, you said charm if nothing's happening, versus what the actual pricing is, and you know, that might be competition between market makers. Maybe, you know, one market maker has a stronger sold call position than another. You know, but you know, the aggregate pricing is what's on there, and then if we have aggregate dealer positioning, I can see what the Vanna and Vega impacts are, and this gives me guidance on what to look for. So thank you.
You know what? I mean, this is a little bit related and a little bit unrelated. What might be kind of interesting, you may already do this in a different terminology, is to be able to tell us, define as a Greek, we called it tilt, okay, and it was essentially skew. And we measured it like you would measure delta, you know, gamma, vega, theta, all that stuff. And you call it whatever you want, but we wanted to know what our skew risk was, right? How much of that, how much exposure do we have on that curve, right? And you do that naturally already by telling us what the dealers have on out of the money calls versus out of the money puts. But if you could quantify that whole tilt of the combined metric, because you know, if I had short call, long put to the, you know, and I would be long stock in the middle, I absolutely wanted that underline to kind of creep up, you know.
Yeah.
Even
I have
if
a bunch
any kind of move up was a
around
home run. Any kind of small move down would suck, right? Now, a gigantic move down is a little different because I have gamma to the downside, and it's converse the other way, right? So you're going to find dealers really moving skew depending on what that position looks like for them, right? They're going to move price pretty damn quickly.
Yeah, that's what I think is what I'm getting at. But I have like a bunch of reference books around, and I'm sure there's probably people out there confused. So this is the book that I have on my desk that has helped me the most with Vanna and Vega.
What's it called? It's blurring out like your face.
Yeah, I know. I'm trying to get it.
Okay.
There we go.
Yeah.
Trading Volatility.
Who's it by?
Bennett. Yeah. Is that's the Colin Bennett book?
Yeah, I think I know that one. Hey, send me a gift, will you? Send me that. I'll read it. I'll read it over the weekend.
I'll send you a gift
with a nice bottle of what?
With a nice bottle of something.
Actually, that book was given to me from my son for my birthday, and I'm like, oh, nice. Thanks. And then I read it. I'm like, oh, this is really helpful.
Nice.
Awesome. All right, we should probably this was a good conversation. It really was. This is very interesting. But you know, I think we could talk on probably another session, on this. So let's think through that over the week.
We're overdue for a zero DTE charm session.
Yeah, I've got some new theories on zero DTE. I was going to talk about it today, but we'll get to it next time.
Okay.
So cool.
Sounds good.
All right, you guys have a great week. First week in the new year, maybe second week. No, first week. This is kind of fun. We'll talk about your prediction for 2024 too next week.
Oh, yeah. We'll be the last. We'll be the last, so we can read everybody else's. And then...
Yeah, not that I believe anything. So here we go.
And yes, agree to the comment about you and Sinclair's books are fantastic. He's also
I agree.
Sinclair.
is it called Trading Volatility? He has positional options trading. He has a couple out there.
What's his first name?
Yuan, E-U-A-N. He's in your neighborhood.
Yeah.
Yeah, that's good beginning. That's good. A good beginner. He doesn't have much in there about Vanna, but
and who's the author of your book there, Jason?
Colin Bennett.
Okay.
That's the book that I'm using here because out of the books that I have, like you have Nattenberg and Sinclair and a few others.
I've got a really good one too
about Vega and Vanna hedging.
Yeah, I have a good one on understand implied volatility. I forget the guy's name. I have it over here somewhere, but I'll send it to you too. Okay, guys, good.
Ogden, volatility, edge, and options trading.
That's it, Ogden. You got it. That's the one I'm trying to think of. AUGEN, Mark.
Yep.
What if Mark stood up and he was in his PJs like I am?
This isn't just for show here. We got Volatility, Edge, and Options Trading by Jeff Ogden.
I love that book. That was great.
That's a good one. And then this is the Ewan Sinclair, Positional Options Trading.
Okay.
Yeah, I have that one.
All right. So I got to read two. I got one down, Ogden, or however you say his name.
McMillian's another decent book. I'd put that in the same class as like a Natenberg.
I agree with that.
If you really want to geek out, you can get the Taleb Dynamic Hedging book. That's for people with a little bit of math chops, though.
Okay. Yeah. Cool. All right, boys. Good to see you. We'll talk next week. We'll continue the conversation. We'll hit a little 0 DTE. My new, just as a teaser, it's not 0 DTE. It's 0 plus 2 DTE. Ooh.
We'll talk. He's doing calendars.
Uh-oh.
Oh, man.
Oh, no. Here we go. I hate when you make 120%. It sucks.
Yeah, but you're making 120% on like that $2. Is it 120% on your margin or is it 120%?
It's you say 120%. It's kind of relative. Don't worry about it. Don't worry about it.
I don't know if I can wait until next week for this.
That's right. All right, guys. You guys have a good week and a good weekend. All right. Good seeing you.
All right. Happy trading.
Happy trading.